Joining me now is David Wessel. He's director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. David, where is the crisis for a rate cut this time around?
Well, there isn't a crisis, but you don't need a crisis to cut rates. I think the reason the Fed is likely to cut rates is threefold. One, they think they made a mistake and overdid it in December. Two, they're quite concerned that inflation has been softer than they expected, and they want to prevent inflation and, importantly, inflation expectations for weakening. And third, they see a lot of risks over the horizon, particularly in the global economy, slowdowns in Europe and China. So they're basically buying some insurance against a bad outcome for the U.S. economy.
But as we heard, and I'll be curious to see if Eric Rosengren does dissent from this rate cut decision today. He told Sarah Eisen a couple of weeks ago that insurance isn't free and that the premium or the cost in this case could be financial stability. I mean, you got to admit these bond yields are wacky around the world.
Right. So I think there are two reasons not to cut. One is that since the last meeting, the economic data in the U.S. has been more positive than negative. So maybe the economy, they can afford to wait. I don't think they will, but that's one. And the second one is exactly the point that Eric Rosengren makes, that with interest rates so low and people now expecting them to go lower still, are we going to see the financial excesses that led to the instability of the Great Recession? And so there's a cost. And the question really at the Federal Reserve that the Open Market Committee has to decide is, are they willing to take that cost? Rosengren sounds like he's not. Right. I think the majority of the committee is willing to pay that price, take the risk of financial instability.
Right. And you're saying that you're also looking to what they signal about further cuts. You know, in other words, is this just a one and done cut, or are there more to come? And what are they going to do with the balance sheet? Right.
So I think that I think it's going to be, I guess people always listen very carefully to the chair's press conference. This one more than most. We won't have the advantage of the dots. So people really will be listening carefully. If they cut rates a quarter, as I expect, what will they be saying is necessary for them to cut rates again this year as the markets anticipate? Of course, he'll say it depends on the economy and all that.
Right.
But is he leaning towards cutting or not? On the balance sheet, I think it's kind of a non-issue. They've already said they're going to stop shrinking the balance sheet in September. Maybe they move it up a month or not. I don't think that really matters. I think the other thing that's going on here is that they have to be able to convince us that they're doing what they're doing because they believe it's what the economy needs, and they're not bowing to the pressure from President Trump.
Right.
And that's really a really unusual situation. We don't usually have these tricky decisions made with so much noise from the White House.
Yeah. And, you know, one larger point on this, if the issue for the U.S., you know, inflation very low and, you know, if it's structural, if it's demographic, if it's because of all the things I said Scott Minerd alluded to, we need to get more people in the labor market. He even mentioned the opioid crisis is a problem with that. What is that something that we should look to the Fed to, quote unquote, solve?
Of course not. I think you answer your own question. Monetary policy can do what it can do, and we've put too much pressure on monetary policy for the last couple of years. There are lots of things in the U.S. economy that could be better, and they're really the province of the president, the Congress, and state legislatures. And it's unrealistic to expect the Fed to fix every problem, even though they sometimes pretend like they could.
I worry we see where this goes when we look to Europe and we look to Japan. They brought rates down before. Now they have to go to more and more extreme measures. There's any reason to think that wouldn't happen here?
No, I think, look, yes, it's a risk. Maybe we should run even bigger budget deficits so the Fed doesn't have to carry all the weight.
You know, that's such a D.C. joke, David.
Sorry. I've been here too long, right?
Yeah, but it's great to see you. Thank you, sir. Appreciate it.
You're welcome.
Great preview of what we might hear in a couple of minutes' time. David Wessel from the Brookings Institution.